Chemical markets are navigating one of the largest supply disruptions in history because of the conflict in the Middle East. And it's reshaping chemical demand, feedstock, margins, and supply chains in real time. I'm Rob Westerveld, Head of Content Integration for S&P Global Energy's Conferences, Training, and Strategic Media Group. In our recent webinar, Chemical Markets Under Pressure, What's Next? Senior S&P Global Energy leaders broke down what's happening and what it means for decision makers in the industry right now in a preview of the discussions that are going to happen at the World Petrochemical Conference, which will be held in Houston, March 23rd to 27th. The top takeaway was clear. This is an unprecedented shock. The disruption in the Strait of Hormuz has flipped petrochemicals from chronic oversupply and weak margins to acute feedstock and product tightness almost overnight. We all know the Strait handles about 20% of global crude shipments. For some key chemical product chains, it's about the same ratio. For methanol, it's at 20%. For Middle East olefins, it's a little less than that, but a substantial portion of Middle East production, of olefins production, is centered in the Middle East, as noted by Andrew Neal, Vice President for Chemicals at S&P Global Energy. And this shift does create risks and some near-term winners. North American ethane producers suddenly have a major cost advantage, but persistent shortages and high prices do raise the real threat of demand destruction against what remains a fairly weak demand outlook. Short term, there are supply shortages, but oversupply remains an issue for the chemical industry. Across Asia, we're seeing force majeures. We're seeing crackers run at reduced operating rates. And as Mark Eremo, special advisor for S&P Global, noted, we've essentially turned the spigot off at the very start of the global chemical supply chain. Knowing your supplier's supplier and what's happening is critical. A few other points stood out from the webinar. If you're running ethane-based capacity, as I noted, in North America or on imported U.S. ethane in Europe, you're sitting on a very strong cost advantage right now. Brent's exceeded $100 a ton. The ethane hasn't moved nearly as much. That window is open, but it won't stay open forever. Second, contract pricing is lagging reality. Most March contracts were settled before hostilities started in late February. Those April resets are going to be very painful for buyers who have to absorb a step change in cost with limited ability to pass through. And third, this is a full-scale supply chain resilience test. Again, our teams are tracking huge price movements and disruptions across shipping, insurance premiums, and restart timelines. And even when the Strait does reopen, it will take months to bring refineries and crackers back online to normalize operations. And this isn't a one-off, as Kurt Barrow, Senior VP and Head of Oil, Fuels, and Chemicals Research for S&P Energy noted. It's the fourth major supply shock in 6 years, following COVID, Ukraine, tariffs, and now this. This forces a strategic question, as Kurt noted. Do you optimize for cost, or do you try to build resilience in this type of environment? That raises into question the need for vertical integration, nearshoring, long-term offtake agreements, even if they cost more. This is a pivotal moment for the industry, and all of this will be at the top of the agenda for the World Petrochemical Conference in Houston, March 23rd to 27th. The forum will bring together leading CEOs, S&P Global Energy's latest market forecast, and direct visibility into what's happening in markets right now. Visit wpc.spglobal.com for the latest agenda and updates, and see you in Houston.